Your rent is not set by your paycheck. It's set by the price of the next empty unit. And that tiny detail explains why rent can soar while wages refuse to move. Picture your last renewal. You did everything right, worked hard, maybe got a tiny raise, and then the notice arrives. Your one-bedroom jumps from $1,500 to $1,800 a month. Same walls, same faucet that drips, same paycheck. You feel like the floor just tilted under your feet. Here's the frustrating part. You're not imagining it. In places like Phoenix, Tampa, and Austin, rents leaped by 20 to 30% in barely 2 years while median wages crawled. That difference is not a rounding error. It's the difference between saving for a down payment and watching your savings evaporate. Why is this happening to you right now? Because rent doesn't care about averages. It cares about scarcity in the exact block where you live. When 2 buildings within walking distance fill up, your landlord suddenly has leverage. When vacancy falls by even a few doorways, the price of the next lease jumps, and your renewal gets dragged up behind it. But there's a piece almost nobody tells you. It's not your boss versus your landlord. It's not even you versus the market. It's a hidden mechanism that runs like clockwork beneath your daily life, and once you see it, you can predict where rent will bend and where it won't. Here's the setup. Think about chairs at a party. There are 10 people and 9 chairs. Music stops. One person is left standing, and the price of that last chair becomes the entire game. Apartments work exactly like that. If a building has 1 vacant unit out of 50, that single empty unit decides what everyone else pays next. Not because landlords are villains, but because that is the price that clears the market at that moment. If someone is willing to pay $1,900 for that empty 1-bedroom, guess what your renewal is going to reference? Not your wage growth, not your loyalty, the last signed lease. But here's the twist that changes the math. That last lease is heavily influenced by a chain of costs and constraints you never see. And when one link moves, the whole chain tugs your rent. Start with the landlord's calculator. Owners don't wake up and roll dice. They live by cap rates and debt payments. If a building costs $2 million and investors expect a 5% return, the property needs roughly $100,000 of net operating income. Now interest rates rise, debt payments go up, insurance spikes because of storms, property taxes get reassessed. The investor still wants 5%. Something has to give. And because walls can't move and debt contracts don't negotiate, the only flexible line item is rent. One landlord with 20 units might only need an extra $50 per unit to keep the math alive. Multiply that across a city of thousands of buildings, and the overall asking rent shifts up like a tide. Wait, it gets stranger. Wages. Don't move like that. Your wage is sticky. It adjusts annually, maybe. It's negotiated with one employer who has a budget. Rent is not sticky. It resets every time a lease ends somewhere near you. That means rents can sprint while wages jog. The moment demand surges, maybe a new tech hub opens, maybe remote workers flood into a warmer city, those last empty units vanish, and the price of the next lease leaps. Your paycheck stands still. Your landlord points to market rates, and your wallet feels the whiplash. There's more. New supply arrives with a delay, measured in years, not months. You can hire a new cashier tomorrow. A developer can't summon a new building out of dust. Permits, zoning, financing, construction. Each step is molasses. So when demand jumps today, the response is tomorrow's tower. That lag turns small demand shocks into big price spikes, especially when vacancy is already low. And when the central bank hikes rates, developers shelve projects. 2 years later, less new supply arrives, keeping the vice tight. But here's what nobody tells you. The rent you see on a listing often isn't the real price. Buildings play with concessions. They might advertise 1 month free or a gift card instead of cutting the sticker. Why? Because lowering the official rent hurts the building's appraised value and triggers investor headaches. So the number on the sign stays high. The real price goes down quietly through freebies. If you're renewing, you don't see the free month the new tenant got. You just see a big number and feel stuck. Let's zoom in. Meet Maya, a teacher renting a 1-bedroom for $1,500. Her landlord owns a 50-unit building. After insurance jumped and the adjustable rate loan reset higher, the building needs an extra $40,000 a year to keep the same return. That's roughly $67 per unit per month. Meanwhile, a new group of remote workers just moved in nearby, and 2 buildings down the street are fully leased. When a single unit in Maya's building opens, it rents at $1,800 because a newcomer is willing, and vacancy is near zero within a 3-block radius. Maya's renewal comes in at $1,780. None of this considered her wage. It considered 2 things: the price of the last empty chair and the math of the building's finances. That's the cause and effect chain. But there's a catch. The exact same mechanics work in reverse when vacancy rises. They just move slower. Leases are contracts. People don't move every month. Landlords resist cutting headline rents because it affects valuation. So they widen concessions, waived parking, free storage, 2 weeks free, lower deposits. That means the true cost can fall before the official number does. If you only watch the sticker price, you miss the window where your negotiating power is strongest. And this is where things get interesting. Algorithms have entered the chat. Large operators use pricing software that monitors nearby vacancies, recent leases, and move-in dates, and then nudges rent daily like a rideshare surge. If the software sees a cluster of units expiring in the same week, it lowers offers to fill them faster. If demand spikes before a holiday, it raises them. You're negotiating with a spreadsheet armed with live data. The headline makes it sound sinister. The practical truth is sharper. If you learn to watch the same signals, vacancy in your submarket, the calendar, the pipeline of new buildings, you can step in when the software relaxes. Tuesday at month end with 3 empty 1-bedrooms? You have leverage. Let's pull back to the city level. Most people assume rent tracks wages because people can only pay what they earn. But the city's composition changes. When higher earners move in, the market rent shifts, even if your wage doesn't. That's not theoretical. During the pandemic, families with coastal salaries moved into Sunbelt cities. They didn't just bring laptops. They brought a willingness to pay more than existing residents. The last empty chair priced at their budget, not yours. Your landlord followed it up. That's how the rent can detach from your paycheck and latch onto someone else's. Another layer, replacement cost. If it costs more to build the next building, higher lumber, pricier labor, tougher financing, then the floor under rents rises. Why? Because investors compare. If a new building needs $2,000 a month per unit to be viable, owners of existing buildings know the competition can't sustainably undercut that. That sets a baseline that resists falling, especially in neighborhoods with strict zoning where you can't easily add chairs to the room. You feel it as, why is nothing available under $2,000 anymore? Now you might ask, what about recessions? Don't rents fall when the economy stumbles? Sometimes yes, especially in downtowns that lose commuters. But the important detail is the timing. Wages can drop fast through layoffs. Rents drift down slowly through higher vacancy and heavier concessions. If you blink, it looks like rents ignore the downturn. They didn't. They just took the long ramp. That lag is your window. Remember Maya? A year later, 2 new buildings open nearby, both behind schedule and hungry for tenants. Suddenly, there are 20 empty 1-bedrooms within walking distance. On paper, the average asking rent is still $1,800. In reality, Those buildings offer 6 weeks free and free parking, which reduces the effective rent by around $200 a month. Maya's landlord now faces a choice: hold price and risk losing renewals, or offer concessions. That's when Maya emails a specific ask: keep the base at $1,590 if she signs an 18-month lease, or match the 6-week concession. She points to 3 nearby listings that prove it. She's not begging. She's anchoring to the new marginal lease. Wait, it gets even more counterintuitive. Moving during peak months is like trying to buy flights during a holiday weekend. Summer and early fall bring waves of leases ending, graduates moving, families shifting for school. Demand swells, prices rise. Winter months? Fewer movers, landlords want occupancy stabilized into year-end. That's when 2 magic words appear: flexible and bonus. If your lease is up in August, ask to extend month to month until December for a modest fee, then renegotiate. The calendar is a quiet lever. There's also the class of building. New, shiny properties often chase image and appraised value. They avoid cutting the sticker, which means they lean on concessions hard. Older buildings have more freedom to cut the actual rent. If your goal is a lower monthly payment, hunt older stock in neighborhoods with rising vacancy. If your goal is nicer amenities at the same payment, target new buildings and ask for the longest concession you can get. You're not window shopping, you're exploiting how valuation math and marketing incentives collide. So what does all this give you besides frustration? Control. Start watching 3 simple dials: local vacancy, new supply, and concessions. Vacancy tells you chair count. New supply tells you if more chairs are about to show up. Concessions tell you the true price behind the sticker. You don't need fancy tools. Walk the neighborhood. Count for lease signs. Search listings with the words 1 month free or 6 weeks free. Call 2 nearby buildings and ask about move-in specials. If 2 or more offer freebies, you have leverage. Ask your landlord to match the effective rate, not the headline. Second, time your move like a strategist. If you can, aim for winter. If you can't, push your lease into an off-peak month. Landlords prefer certainty. Offer a longer term in exchange for a lower base rent. Or flip it, accept a slightly higher base if they give bigger concessions up front. The effective monthly is what hits your wallet. Use that math. Third, negotiate with data, not emotion. Say, 3 buildings within 5 blocks are offering 4 to 6 weeks free on 1-bedrooms. That brings the effective rent to around $1,600. I'm happy to sign for 15 months today if we match that. Anchors, specifics, and readiness to sign now convert better than this is too high. Fourth, expand your radius by 10 minutes. Rent is hyper-local. 1 subway stop or a short drive can swing vacancy and kneecap the price. If you find a submarket with multiple empty chairs, you become the scarce resource, not the unit. Fifth, consider house hacking or co-living not as a lifestyle statement, but as a bridge. If you split a 2-bedroom or rent a small home and add a roommate, you're effectively creating your own extra chair in the game. That lowers your effective rent while you build savings. Finally, track your personal rent-to-income ratio. Landlords often use 30% of gross as a quick screen. If your ratio is above that, focus on effective rent reduction through concessions and location moves. If you're below that, you have room to prioritize quality of life without straining your budget. That awareness alone can calm the panic that the sticker price tries to trigger. The big revelation is this: your rent is a story about vacancy, cost of money, and replacement cost, not about your worth or effort. When you understand that the price is set at the margin by the next empty unit, you stop taking a lease renewal as a judgment and start treating it as a negotiation anchored to real, local facts. You stop fearing the number and start dissecting it. Remember the chairs. If there are not enough, the music feels cruel. But music changes. People move. Buildings open. Concessions appear. Your job is not to fight the entire market. It's to find the pocket where the chairs outnumber the dancers and sit down early. Most people think rent is a fixed wall. Now you know it's a moving target tied to a handful of levers you can actually see. So the next time a renewal hits your inbox and your wage hasn't budged, don't freeze. Scan your block for empty units, note the concessions, check the calendar, and counter with an offer that matches the real effective rate. If the building won't play, shift 3 blocks to where the chairs are plentiful. Your paycheck doesn't set your rent vacancies due. Find the empty chairs, and you control the music.